Hi, the main lesson today was to recap recording in the analyzing chart and the general ledger. More specifically, we looked at how to record cash and credit sales. The first thing to remember is the double entry recording rules. So the first one is that the debits must always equal the credits. And that there's always at least two accounts affected in each transaction. So looking at a cash sale, there's always 4 accounts affected. They would be bank, sales, stock control, and cost of sales. For a credit sale, it would be debtors control, sales, stock control, and cost of sales. So if I give an example at the moment, if Cindy sold one book at $50 selling price and $25 cost price on cash, the entries would be in an analyzing chart. The accounts affected would be bank, increase, it's an asset. The money going into the bank is actually $50, the selling price. And if you look at the table we looked at the other day in your textbook, it's a debit entry. Consequently, we'll have a sales account created. It's a revenue at $50. We credit this account. These two accounts become a pair where the debits equal the credits. At the same time, you are selling the stock, so you have one book less, which means your stock control, which is an asset, will decrease. At the cost price, $25 credit. And now we've created an expense in this transaction called cost of sales, increase, $25 debit. And again, our debits equal our credits. If we only record the top 2 accounts, it looks like we've actually earned $50 in total. But in actual fact, if we look at our revenues minus our expenses in this transaction, which is $50 minus 25, the net profit earned is $25. So it's important to recognize this expense, cost of sales. Alternatively, if we have a credit sale, we simply use debtors control, debit, instead of bank. If we look at the example in 3.3 in your textbook, on the 4th of January, they sold one mower for $700 cash and its cost price was $500. In the analyzing chart, we will put 4th of January. The accounts affected, as we said before, there's 4 accounts affected. Bank, sales, cost of sales, stock control. Bank is an asset. It will increase because we are making a sale. Debit $700. Sales is a revenue. It increases. Credit $700. Cost of sales, remember, is an expense. It increases at cost price of $500. And cost stock control is an asset. It decreases So we credit 500. Then we transfer this information into the ledgers. So if we go to the bank ledger, the way we read this table is it tells you that bank debit 700. Now remember the debit side is this side and the credit side is on the right hand side. Bank is an asset, it increases on the left and decreases on the right. So we're going to debit 700 bank on this side, 4th of January, $700, and it was paired with sales. So we're going to write sales as a cross-reference. Then we go to the sales ledger and do the other side. So this one was on the debit side. Now we're going to sales. On the credit side, 700. 4th of January, 700, and it's paired with bank. So we're going to write bank in the cross-reference. Now that pair is complete. We do the other two accounts. Cost of sales expense increase, debit on the left-hand side. So we've got a cost of sales on the left-hand side. 4th of January, the cost price was $500, and it's cross-referenced with stock control. Now that we've done the debit entry, we do the credit entry in stock control, where we credit 500, cross-reference with cost of sales. And that's how you record a cash sale. Thank you.